Ciancola, I noted that the Minister for Finance, Michael Noonan, speaking at a recent Parliamentary Committee on Finance, said there be no question of write-offs. Longer maturities and low interest rates or low interest were at the core of the discussions on the promissory notes. On the issue of money put into the so-called functioning banks, Bank of Ireland and AIB, etc., he said there would be an examination of the possibility of some of the rescue loans having maturities extended. It seems to be increasingly obvious that there will be nothing particularly special about the deal for the special case of Ireland promised in June last year. Yet the arguments for a very special deal are overwhelming. The economist Michael Taft has done some very illuminating number crunching with Eurostat statistics of the banking crisis in Europe from 2007 to 2011. The cost to the Irish state, excluding cash from the Pension Reserve Fund and the NTMA, etc., was 40.1 billion, just ahead of Germany, which had 40 billion. However, we have just under 1% of the population of the EU and 1.2% of the GDP of the EU. That 40.1 billion is 25% of our GDP as compared to 1.5% of Germany's GDP. We have paid for 42% of the total bank bailout in the EU. That's 9,000 per head as opposed to an EU average of €192. The key question, I think, is will the deal be negotiated change these unbelievable figures? And I think the answer is no, because the government has not sought to do so. You have tamely accepted the situation by saying we pay our debts and are not seeking a write-down. Ireland was forced into this situation on the ECB insistence of no burden sharing for bondholders. The ECB and the EU Commission should now be forced into taking its share of the burden. Instead, we have a retreat from the promises made in June last year and an increasing inconsistency in the dealings of the Troika with different countries. Last week there was a leak in the Financial Times of a draft by the EU Commission on the ESM and bank bailouts. This ruled out any question of legacy debt being dealt with by the ESM. It went on to say bank rescue must first rely on private capital, then state funding, and only as a last resort by the ESM. It's only a draft, but taken in conjunction with the Helsinki 3 statement, this is a very serious retreat from the commitments of the June summit last year. I want to also raise the inconsistency of the Troika. The insistence of the no write-downs or haircuts for bondholders applied to Ireland has not applied to Greece and is unlikely to be applied to Cyprus. My understanding of the crisis in Cyprus is partly a byproduct of the default by Greece last year. The Cypriot banks were major holders of Greek sovereign debt, and they took huge losses on these bonds last year. They are now bust, as is the Cypriot government. The cost of their bank bailout will be between 60 to 100% of their GDP. It is alleged that a lot of hot money went into Cypriot banks, and a lot of that from Russia. The IMF are pushing for a haircut, not just on bondholders, but possibly also depositors. It seems that bailing out Russian oligarchs with taxpayers' money is a step too far even for the Troika. Rather than raise these issues of unfairness and inconsistency, this government repeats the mantra, we pay our debts, we don't want to write down, just give us a little break and we'll be happy. Finally, I want to refer to remarks made by the People for Profit Alliance in this debate. Listen to one or two contributions from the government side. I was reminded of the old Dublin expression, there's not much point in being an idiot unless you can prove it. The Greek people are not benefiting from the kindness of the Troika. They are being crucified. The health service has effectively collapsed. We've seen the report today, and has been mentioned a number of times today from the National Office of Suicide Prevention in Ireland and the Public Health Authority, that the alarming and distressing reports of that Greece has one of the highest increase in suicide rate from 2008 to now, from the start of the austerity in Europe. Greece has third world conditions, and I've been visited. Third world conditions have been visited upon the people of Greece in the European Union, and for what? An austerity programme that cannot work. It just cannot work. According to the IMF, Greece will not meet the target to debt to GNP from 170% today to 120% by 2020. Their best bet is 135%, and that means all fiscal adjustment targets and some growth within that. Even if this level, 135%, were met, which it won't, there is no question of re-entering the international market for finance. What has been imposed on Greece is not a solution, but a social and economic disaster, and people for profit have the responsibility and are proud to oppose it and state it clear what it is. And finally, in relation to the idiotic remarks made about the former Stalinist regimes in Eastern Europe, maybe some TDs should get someone in their office to look up the difference between Trotskyism and Stalinism and have it very slowly and very carefully explained to them. The level of debate might then rise a little in the Dáil chambers.